Thank you for joining our webinar called Demystifying US Equity Quotes and Prices. This is the first part of a two-part webinar, and today we will be focused on venues, quotes, and prices. My name is Stéphane Dubois, and I am the CEO and founder of Xignite, and I'm very excited to tell you about this subject today. Let's look at our agenda for this session and the next. Today we will be focusing on venues, quotes, and prices. I will provide some background on the topic, cover US equity venues, and then deep dive into the different types of quotes and prices. In the next session, we will talk about cost, delivery, and integration. We will talk about the fees and the various agreements and reporting and usage associated with US equity quotes, and we will talk about delivery and integration of data. So let's focus on part one. Let me start with a little background on the industry. Let's talk a little bit about who this webinar is for. The type of audience that we have in mind for this would be a developer. Let's say you are working and building a new application, or a product manager or project manager. You're either learning about the industry or maybe, again, working on a new set of applications. Your level of expertise should be novice, intermediate. If you're a low latency person or an industry expert, this is not a webinar for you. You'll probably not learn much from there. If you're trying to find the easiest and cheapest way to get US equity data, then this is the right webinar for you. Now we talk about quotes and prices for US equities. Now how hard can that be? I mean, we all know, we have all used all kinds of applications with, quotes and things like that. It seems like a fairly simple problem. But once you start peeling the onion, you realize that there's a lot of complexity to it. We talk about, you hear things like level 1 prices and level 2 prices and NBBO and last sale versus closing price. So the subject becomes quickly much more challenging than it appears on the surface. And hopefully with this session, we'll demystify some of this for you. Let's start at the top. We're talking about equities here. If you think about various asset classes, obviously equities is only one of them. This chart actually shows you a handful of things. So here we'll be talking about equities, which can be broken out in terms of common stocks and preferred stock and warrants and American depository receipts and whatnot. We're not going to talk about funds, even though we will talk a little bit about them because some of them are traded on exchanges where equities are also traded. We will not talk about derivatives, and we will not talk about fixed income instruments. We'll focus on equity, prices, and quotes. Now equities, as we know, are traded on exchanges. There's different types of exchanges out there. So our focus will be, of course, stock exchanges. But stock exchanges trade stocks, funds sometimes, exchange-traded funds, and related securities. They do that through either an auction process like the New York Stock Exchange or an electronic process like NASDAQ. You have other exchanges out there, future exchanges who trade future contracts like CME, option exchanges that trade options in stock or futures like the CBOE, the Chicago Board of Option Exchange. And you even have a handful of bond exchanges in the U.S., like NYSE ARCA bonds. And again, this will not be the focus of this discussion. Now let's take a simple regulatory view and pretend with the SEC, which is the government agency overviewing this industry. The regulator looks at things in three categories, if you want. You have exchanges, and you'll recognize some of the names that we're familiar with. And there are actually 7 exchanges approved to be stock exchanges in the U.S. And each of those has several actually sub-exchanges as part of it, so for a total of 15 exchanges. So of course we have the New York Stock Exchange, with actually the New York Stock Exchange being one of the exchanges. NYSE ARCA, you have NYSE Market, which is what we used to know as the American Stock Exchange. NASDAQ itself has more than 3 exchanges for equities. You have the NASDAQ itself, you have BX, which is the old Boston Stock Exchange, and the PSX, which is the old Philadelphia Stock Exchange. We also have some names that you're probably not as familiar with if you're not deeply knowledgeable about the industry. BATS Trading is the third largest exchange in the U.S., and it actually has two markets to trade equities. Direct Edge is the fourth largest, also has two exchanges. And you have the Chicago Stock Exchange, known as CHX, the National Stock Exchange, known as NSX. The Chicago Board of Options Exchange also trades equities, CBSX and C2. And finally, the International Stock Exchange also is approved to trade equities, but doesn't do that today. So these are really regulated exchanges, recognized as such by the SEC. Equities are actually traded on other places, or at least reported on other places, which are regulated differently. You have OTC markets, and you have officially two OTC markets in the U.S., the OTC Bulletin Board, and a company called OTC Markets Group, which is also known as the old pink sheets, if you want. And we will talk about those in more detail. Finally, you have what's known as electronic crossing networks or alternative trading systems, sometimes also known as dark pools. And you have dozens of those in the U.S., some of which are actually crossing networks or consolidators of dark pools. So you have a lot of different flavors there. Those are actually regulated separately by the SEC, but they play an important role in equity markets. And we will talk about those a little bit more as well. So with this little background, let's start diving into some of the interesting stuff. I listed all the stock exchanges in the previous slide, but let me give you a little bit of a history of the U.S. stock exchanges. Now, this is probably the most complicated slide we're going to have on this webinar, and if, unlike me, you're not that interested in the history of capitalism in the U.S., you might find this slide overwhelming. If you are actually interested in this types of things, you will find it fascinating. This essentially traces back from their origins back in the 1790s all the way to today, the whole history of stock exchanges in the U.S., and essentially the explanation of why we have so many stock exchanges left. So you'll learn, for example, that our first stock exchange created in the United States was the Board of Brokers, which became the Philadelphia Stock Exchange. That started in 1790. That exchange consolidated with the Baltimore and Washington and Pittsburgh Stock Exchange to eventually merge with NASDAQ in 2008. The Boston Stock Exchange is also very old, 1834, and it did merge with NASDAQ in 2007. You have Instinet and Island, some of the two first electronic networks started in the 90s. Instinet goes back to the 60s, merged in 2003 to create INET, eventually acquired by NASDAQ in 2005. Now, NASDAQ itself, where does it go back? Well, the National Association of Securities Dealers was created in 1938. It created its quotation system, NASDAQ, in 1972, and it became what we know today. NASDAQ, the regulatory arm of our industry, the brokerage industry, eventually split up from NASDAQ in 2002 and merged with the regulatory arm of NYSE to create FINRA. And FINRA is the private company that essentially regulates, self-regulates the U.S. securities market today and actually administers some of the OTC markets, as we'll see in a few minutes. So this is for the NASDAQ branch. Right? How about the NYSE branch? Well, NYSE goes back to 1817, not as old as the other one, and pretty much went on its own for a long time until 2006, when it acquired ARCA, NYSE ARCA, known today as NYSE ARCA. And ARCA was the result of the Archipelago Securities Exchange, started in 1997. Itself had merged with the old San Francisco Stock and Bond Exchange, which was then called the Pacific Stock Exchange, and eventually merged into the NYSE. Amex, as we know as the American Stock Exchange, was created in 1908. Went on its own for a while, had a short while merging with the NASDAQ, and eventually merged in 2008 with NYSE, and is known today as NYSE market. Now, these are the two big ones, NASDAQ and NYSE. We also have other exchanges in the U.S., very rich history of capitalism here. Direct Edge was started in 1998 in the middle of the craze of electronic exchanges. Eventually was passed tonight and was spun off as Direct Edge in 2007 and acquired part of the International Stock Exchange. BATS, the youngest one of them all, was started in 2005 and has been independent since, even though it acquired Chi-X Europe in 2011. The old Chicago Stock Exchange started in 1882, acquired a bunch of things along the way, but pretty much running on its own since. And finally, the old Cincinnati Stock Exchange started in 1885, became the National Stock Exchange, eventually was acquired by the CBOE, and is now essentially two units, NSX and CBSX, creating the last two exchanges in the market. So this is, for the little quick, hopefully you stayed with me through this little demonstration, history of why we have 7 equity exchanges in the U.S. today, creating actually a total of 15 different market centers. So a lot of history, which obviously is creating some complexity for somebody who's just trying to get quotes. Right? So let's dive a little bit and talk about those exchanges and what they do as it relates to quotes and prices. Something people are confused about is, listing on an exchange versus trading on an exchange. And this is something that used to be very simple, and now it's getting a lot more complex. Listing. Well, a primary listing exchange is the main exchange where a security is bought or sold. Essentially, it's the exchange where the IPO occurs today, for example. Now, not every exchange in the U.S. lists securities. The only ones that do so are NYSE, NASDAQ, CHX, the Chicago Stock Exchange, and BATS. And the last two have very few listed securities. An exchange can be actually approved for listing, but actually not be doing that much of that. So listing is a certain service that you provide the security company, the company that's trying to get listed. It's actually separate from trading. Due to some changes in the regulatory landscape in the U.S., exchanges must, by law, provide best execution to their customers, which means actually routing orders they receive to other market centers. So what happens is when you place an order on a NASDAQ listed security, that order may go straight to NASDAQ, depending on what your broker does with it. Or you may actually go straight to BATS or straight to Direct Edge. But in either case, BATS, Direct Edge, NASDAQ must guarantee best execution, and therefore they will route those orders to other exchanges so that your order gets executed at the best possible price. So what happens as a result is some market centers execute orders for securities that do not list. NASDAQ trades NYSE securities, NYSE trades NASDAQ securities, and many other combinations of the like. Some exchanges are not even the first market center for securities they list. That is, sometimes a NYSE listed security might trade more heavily on NASDAQ than it trade actually on NYSE. So that wealth and complexity, obviously makes it more difficult to figure out, well, what's the quote for this security? Let me give you a little picture of actually listing of securities in the U.S. This shows you across different equities-related asset classes, starting with common stock, funds, which is not really an equities, but that are heavily traded on equities exchanges and somehow dealt with as equities, and other equities-related things like structured products and preferred stocks and ADS and whatnot. So you can see that NASDAQ, for example, lists more than 2,500 equities, common stock. NYSE lists 1,831. ARCA only lists 3, and the old American Stock Exchange lists 358. The Chicago Stock Exchange has 48, right? And you can see for each of those asset classes how many securities are listed by each exchange. So obviously the bulk of securities are listed on NASDAQ and NYSE as well as Amex. and NYSE would include ARCA, which does a huge business trading exchange-traded funds. Now, let's look now at market share. Which exchanges trade and move the most number of shares and the most volume of transactions, if you want. So if you look at market share in terms of shares traded, the cumulative number of shares traded, you can see that NASDAQ trades about 50% of the market. NYSE is next. BATS is third with about 10+%, and Direct Edge slightly under. You can see that the other exchanges, CBSX, CHX, and SX, have a very, very small share of the market. Meanwhile, on a value standpoint, which is the actual value of those trades, the distribution is quite similar. But if you look at the number of trades, then you can see that the number of trades on Direct Edge and BATS are actually much more significant proportionally compared to NASDAQ and NYSE. But what this means essentially is that there's quite a bit of liquidity on exchanges like BATS and Direct Edge, and they provide a very interesting presentation or representation of quotes and transactions happening in those markets. You don't only need to look at a given exchange to understand what the quotes and prices are for that exchange. Now, here's a specific distribution of who trades which securities based on where they are listed. So you can see here for NYSE listed securities, things that you would say they trade on NYSE, that actually NYSE only trades 31% of them. NASDAQ trades 16% of them, and that actually 30% of those trades happen off exchanges into dark pools and other systems. NASDAQ trades 30% of its own listed stock, where NYSE trades 12% of it. And more than a third of the trades happen off exchanges into dark pools and at alternate trading systems. What we call regionals here, which would be Amex, CHX, and the other exchanges who list securities, you can see that NASDAQ and NYSE trade more than 40% of those. The other exchanges trade 30% of those, and actually the regional have a very small share of those trades proportionally. So again, this tells you that NASDAQ gives you a complete picture of all securities listed across all exchanges, and NYSE gives you the same, essentially, because they all trade each other's securities. Let's take a quick example of what we mean here. For those of you who might not completely understand this, this is an interesting little picture. This is the first 10 seconds of one. That the first trade for Facebook occurred on BATS, not on NASDAQ. Then within half a second of that, NASDAQ dumped 140 million shares of the market, which was essentially all the shares from the IPO. You can see that the highest price ever paid for a Facebook stock, which happened on this day, was on BATS. It was also executed on BATS as 45. So this was actually, I think, 409 shares. These were the only shares for which $45 were paid. But you can see overall that most of the trades occurred around the $43 price with some variations. And even though some exchanges executed price at a certain price at a given time, the same trade might have occurred at a different price on another exchange. I mean, we're talking about micro nanoseconds here. But if you take at a given second, right, at a given second of execution, significant variations in prices might have occurred across different marketplaces. And this, of course, creates the depth and wealth of markets and liquidity that we find in the U.S., but also creates complexity from a quotes and pricing standpoint. Let's switch gears a little bit and talk about OTC markets. There is, as I mentioned initially, two OTC markets in the U.S. One is actually called OTC market, and it's the old pink sheets. You probably have heard about those. They were called pink sheets because they were quotes that were printed on pink sheets back in the day. Pink sheets is actually a private company, and it's not an exchange. It is an OTC market, and what they provide is essentially inter-dealer broker quotations. So it's really a quotation system. They have more than 9,000 companies listed with no filing requirements. These tend to be small companies, very closely held, thinly traded. Some of them are high quality companies. Some of them are more questionable quality companies. And what the OTC markets do, they segment their markets in terms of high quality and low quality. So OTC, QX is the higher quality type of securities with more filing requirements, and there's different grades of this over time. Another OTC market is the OTC Bulletin Board. It is a system. It's not an exchange. It's essentially, again, an interdealer quotation system. It is operated by FINRA. It is essentially regulated by FINRA, which is itself a private company, even though the data is reported through NASDAQ because of the old affiliation between NASDAQ and FINRA. But it is not affiliated with NASDAQ in any way. Often people will say, well, it's a NASDAQ stock, but really it's not. It's an OTC Bulletin Board security. More than 8,000 companies are listed on the OTC Bulletin Board. They have filing requirements with the SEC, so it's a little more stringent than OTC markets. What you'll find typically, they are delisted companies, companies whose stock went under $1 and they don't meet listing requirements, so they go from NYSE or NASDAQ or Amex down to the OTC Bulletin Board. It's not unusual for companies to appear both listed on the OTC Bulletin Board and on the pink sheets as well. So these are not necessarily exclusive markets of each other. Now, how about mutual funds, you ask? As I said, mutual funds are not exchange-traded funds. Those are traded on equity exchanges. They are not traded on stock exchanges. They don't have any quotes and prices. They have NAVs, net asset values. And even though those net asset values are reported through the NASDAQ mutual fund quotation system, mutual funds are very, very different from equity prices. So when I'm talking about equity prices, what I'm talking about is just stocks, preferred, and because some exchange-traded funds are traded on those equity exchanges, those as well. How about indices? Well, indices are not securities. They're not traded. They have no quotes and prices. They have values that are calculated by the index company or the exchange, if this is an exchange index. They are subject to completely separate licensing and rules, so they really don't have anything to do with equities, even though they're based on equities. So those will be subject to future webinars. And again, everything we're talking about wouldn't apply to any of those two asset classes. So key takeaways from this initial session. US equity markets are complex, fragmented. Stocks are traded in 15 exchanges and dozens of market standards. Stock exchanges trade more than just stocks. Some stocks are traded in many exchanges. Some stocks are traded over the counter. Some activity occurs in dark pools. No exchange can provide a full quote picture because they all trade a partial amount of their own listed securities. Even the primary listing exchanges for a stock tends to only perform a fraction of the trades for that stock. So all of this impacts quotes and prices. What is the quote or price for this stock? It's not an easy question. So let's dive into the next section and talk about types of quotes and prices. There's really three considerations, three aspects to quotes and prices. The first one is delay. Is it real time? Is it delayed? Is it end of day? The second is depth. Am I talking about the last sale, the best bid or offer, depth of book information, or level 2 information? And finally, it's breadth. Am I talking about a consolidated quote? Am I talking about a single exchange quote or even a single market center? So this is the breadth of information. And all of those affect, the quality, the price, all aspects of this information. Let's dive in a little bit. Delay. It used to be that all exchanges treated delay differently. They had different rules. Now, NASDAQ was 15 minutes. NYSE was 20 minutes. Now, today, in the U.S., real-time data is anything that is less than 15 minutes delayed. So if you get a quote that's 14 minutes delayed, it's real time from an exchange standpoint, from a licensing and a restriction standpoint. There's no difference in treatment between a nanosecond delay or a 14 minutes delay. Delayed is going to be anything that's more than 15 minutes delayed, but it has to be less than 15 minutes after close, right? So if you get an hour delayed quote, it's still delayed, right? As long as you don't get the 15 minutes after close price, which would be considered end of day, and typically is free of any cost and licensing and things like that, you're talking about delayed data. Let's look at depth. This is probably the more complex topic. This full level of depth of information. Each time, if you want, when you talk about price and quotes, and this is really both price and quotes, each level gives you a deeper understanding of what's happening in the markets. The first level is what's called last sale or last price. It's really the same thing. Last sale is just the price of the last trade. At what price did the last trade perform, and what was the quantity traded at this price? This is the easiest piece of information, right? It doesn't give you any indication as to where the market is going. It doesn't give you any quotation, direction, or anything like this. It's just the last price. Note that volume is not included there. Volume is actually the sum of all the last quantities, all the trades. And this information is typically calculated by quote vendors, but is not considered part of the quota price. The second level is the best bid or offer, BBO. It's also called level one information in some conversation. In the level one information, I get my last sale information, which is the previous picture. But what I also get is the best bid and the best offer, which is essentially the ask price, the best ask price for that security, right? So somebody is willing to buy the security for $25.15. Somebody is willing to sell the security for $25.17. The difference between those two is the spread. If I had a match there, I would have a trade. Right? But right now, I've got a slight difference between what people are willing to buy and what people are willing to sell. That's a quote. Actually, the quote would be either the bid or the ask, technically. But when we talk about market data, the quote is really the combination of those two. But here, all I'm seeing is the top of the book. That is the best bid and the best offer. When we get to the third level, I'm talking about depth of book information. That is, not only I see my last sale data, not only I see my best bid and best offer, but I also see all the other prices people are willing to pay and how many shares are they willing to trade at those prices. If I look at this picture, it's going to give me an indication of where the market is. I'm going to be able to see, oh, people are more wanting to sell than to buy, and I can see what the various price levels or support levels are going to be at different price points. So the depth of book information gives me a lot more information about the market and where the quote is, and therefore is more valuable as well. There's another level beyond that, which we call here level 2, and this is where on top of my bid and ask information, I actually get to see who is placing this order. Now, when I talk about in the depth of book, when we look at the bid number and the bid quantity, it's essentially the sum of all the orders at this price. Same for the ask. When I start looking at level 2 data, I can see, well, that 500 shares, at a bid of $25.15 is an order that's been placed on ARCA. And that the actual 2,000 shares at $25.14 for bid is actually a combination of 3 sets of orders, one being on the Brute network, one being with Securities, the last one with Schwab. So I can start seeing who is actually placing these orders, and those who are market makers. There could be exchanges, there could be dark pools, there could be brokers or market makers for the securities. There's dozens, if not hundreds, of firms in the U.S. that could be actually listed there. So here, I even get more valuable information. I get to see who is interested in placing those orders. So let's talk a little bit more about this information. Some clarification. Last sale, last price, same meaning. Close price, it's the last sale price as market close. By the way, you think this is a simple subject. This is actually quite complicated to figure out what the last price is at market close, and it will be the subject of a separate webinar. Offer and ask are just synonyms. A quote is really a bid or an offer, although the term is often used to indicate a best bid and offer. You've heard the term NBBO, National Best Bid and Offer. It's essentially the best nationally consolidated quote, looking at across all exchanges, what's the best bid, what's the best ask. In the previous slide, we broke down depth of book and level 2 data. Those terms are actually often confused. The meaning varies in the industry. Level 2 is sometimes used to indicate depth of book. Level 3 is sometimes used to indicate level 2. Sometimes it's hard to tell the difference. We try to explain it more clearly to you. Volume, by the way, is derived from trade quantities, and those calculations are done by exchanges, but not by exchanges, by quote vendors. And some other fields are also derived by quote vendors. That was the second topic. Breadth of coverage, third topic. Well, if you're going to get a quote, are you going to get a consolidated quote, or are you going to get the quote from a specific exchange? And you remember, we have a lot of those. So some significant considerations there. Now, if you want a consolidated quote, it's a highly regulated part of the industry, if you want. You have an organization called the Consolidated Tape Association, which oversees the dissemination of real-time trade and quote information. It's highly regulated. The pricing is regulated by the SEC to provide fair information to investors. All equity exchanges are members. The CTA, as it's known, essentially consolidates this information. They have all kinds of technology. They have their own system, their own infrastructure. They do all the calculation for the NBBO. They eventually collect all the user fees and distribute those back to the exchanges based on what's been collected. So you can get a consolidated fee. You're going to have to go play by the rules, pay the fees, get the agreements that you need with the CTA. You can also get exchange-specific data. In this case, you only get data from that exchange. It's going to only include securities traded on that exchange. It will only include the trades that were performed on that exchange. It may include securities listed on other exchanges, but you will not get the trades that were executed on the other exchanges. So liquidity and coverage will vary. Some exchanges, NASDAQ might be great at providing liquidity on a given NYSE securities, but less in another one, and vice versa. The bid and the ask and the last sale information and the trade quantities you're going to get are only going to be for that exchange, not consolidated. They're not going to be subject to the same fees as CTA fees because it's just exchange-specific information. Exchanges have more leeway in deciding how this information is priced, more flexibility. So they may, for example, waive user fees, and they may provide usage-based pricing. Even though that information, that pricing is still regulated by the SEC. So this creates, as we'll see in the second part of this webinar, some significant opportunities around obtaining cheaper quote information from a specific exchange. Now, not every exchange provides the depth that we've talked about. You'll see that every exchange has its own ways of doing things. So if you look in terms of the depth of data available by exchange, you'll find, for example, that NYSE will give you a last sale, a way to get last sale information, a way to get BBO information. They have several products for these. And those products are actually feeds. You can get depth of book information, and you can get a consolidated feed from NYSE as well. Same for NASDAQ, although they'll give you level 2 data and not depth of book information. But when you get to BATS and DE and Chicago and CBOE and NSX, you will get less and less granularity in choices and be able to get this data. And your quote vendor, like Xignite, would be able to help you with that. So all those things eventually impact what's probably most important to you: cost and complexity. Delay is a big factor. Real-time data is generally fee liable, and it requires exchange agreements. BATS is the exception in this world, where BATS can provide real-time data to you without fees and without exchange agreements. Delay data tends to be non-fee liable, but it requires exchange agreement and administration fees. For NASDAQ, NYSE doesn't require those. Historical data or end-of-day data is not fee liable and does not require agreement. So if all you need is end-of-day data, and you've resolved most of your problems. If you need real-time data, you're going to have to deal with agreements and fees unless you use that. Depth. Well, last sale data is generally cheaper than BBO data, depth of book, or level 2 data, because it's technically less valuable. BATS is again the exception. You would be able to get to depth of book information, even level 2 data, with actually not level 2, but depth of book information without having to pay additional fees. Breadth, of course, is important. CPA data is the only way that you'll get a full consolidated feed. This data is fee liable. Exchange-specific data is priced separately by each exchange. Each of them have different products with different fees, and we will cover that in the following session. Some exchanges, as we said, make all their data non-fee liable. So determining what's the delay that you need, what breadth of information do you need, what depth of information you need, is going to be an important part of the process of figuring out, which solution is the right one for me, and it will have a big impact on your costs. So this concludes the first part of this webinar. In part 2, we will dive in more deeply into those fees and to the agreements required and the reporting that you have to do and some of the usage restrictions around the data. For example, can I display this data on my website or not? We will also talk about a very important part of the process, which is how you're going to get this data. Is it going to be a feed? Is it going to be an API? And how you're going to be integrating this data with your applications and the cost of that. And finally, we'll finish by demonstrating some easy ways that you can get to affordable financial quotes and prices. The second part of this webinar will be released within a couple weeks. If you've seen this webinar and registered to see this webinar, we will make sure to send you a link with the following one. Some resources for you if you want to look up information on NASDAQ and the pricing information for NYSE, for BATS, for direct hedge, as well as some of the regulatory information we discussed. Here are some links you may want to look at. With that, I'd like to thank you. Feel free to contact me, either because I said something wrong and you need to correct me, or whether you want to ask a question or share any information with me. Feel free to contact me by email or follow me on Twitter. Thank you very much.